Hi, my name is Rahul Baijal. I'm a senior fund manager at Sundaram Mutual Fund based out of Bombay. Today, I'm here to talk to you about IPOs and how do mutual funds approach IPO investing. So before we go deep into that, just to give you a perspective on IPOs, as we all know, IPOs is the route through which the new companies get listed in the Indian stock exchanges. And typically you find, if you look at the last 10, 15 years or so, a few years you have when a lot of listings happen. These are typically the bull market years like 2007 or 2017 or 2018. And then you have slightly weaker years for listings when the market environment is not that conducive. Years like 2011, 12, 13. So it's quite sporadic how the listing activity happens. In some years, for example, the ones I mentioned, you have a lot of listings. So if you look at the last 15 years, around 40% of all listings have actually happened in three big years of 2007, 2017, and 2018. Then coming on to mutual funds and IPO investing, clearly all of us in the industry approach IPO investing very seriously. And at the same time, it's important to, do IPO picking right as well. Just like a good fund manager makes good returns in fund performance through appropriate stock picking, similarly, I think IPO picking, saying yes to the right IPOs and saying no to the wrong IPOs is also critically important. Just to give you a flavor, we have analyzed some data over the last 15 years, and a very interesting trend emerges. If you look at the kind of returns which have been generated in the IPOs post the listings, you will find that over a 5-year compounding of more than 20% returns has been given by about 15, 16%, one-sixth of the listings. And if you're looking for 3-year compounding of more than 20%, you'll find around one-fourth of the listings have given you that kind of returns. So it's very important to identify these set of companies which will give you good 20% plus compounding over a 3 to 5 year period and be invested in them right from the start. And as a parallel, it's very interesting but ironic as well that around 45-50% of fresh IPO listings actually end up giving negative returns over a 3 year, 5 year period. So put this in perspective, mutual funds and fund managers have to be very careful about which IPOs to invest in and which not to invest in, because the return potential, as I just mentioned, over 3 year, 5 year time period is very different. And just like stock picking is important for fund performance, similarly, saying yes to the right IPOs and no to the wrong IPOs is also important. Secondly, in the same context, sometimes you find that there's a lot of fervor around IPO activity. A lot of leveraging is done by the retail investors. A lot of oversubscription happens. So while it's important to do that for the right set of IPOs, but at the same time, investors and fund managers and mutual funds, it also makes sense to sometimes not be too aggressive at the time of IPOs and be patient about timing the companies as well. For example, if there are companies which you like, businesses which you like, but you find the valuation to be expensive, you're better off waiting off for the listing to happen. And later on, when the market corrects or the stock price comes lower, then you can also get in as well. So again, like in normal stock picking, timing is important. Similarly, in IPOs, one has to approach in a balanced manner and not get caught in the frenzy of approaching every IPO. So that's some perspective on how investors and mutual funds approach IPO investing from a return perspective. Then, from a diligence perspective, I think mutual funds and at our end also, we do a lot of diligence for these IPO companies because These are companies which don't have a track record of quarterly results, regular con calls. So it's very important to figure out what are the risks which lie in investing in these IPO companies. So we have a very thorough diligence approach for these IPO companies. We have analysts which prepare the investment analysis reports, and we have a risk team which prepares the risk from a, what kind of risks exist, whether it's corporate governance risk or promoter background risk or financial risk. So all this, along with the business analysis by the analysts, is put in together in a report at the time of the IPO, and only at the end of that analysis and regular discussions is a decision taken on the IPO investment. And I think that's a process which most of the mutual funds follow as well.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.